Hello everyone. These are certainly very challenging times, and I hope that all of you are safe and doing well. Life certainly has a way of throwing obstacles down your path, but remember that it is often in the most challenging times where one can find the greatest of opportunities. The last few months has seen some degree of volatility in the Indian equity markets. However, despite the rise in the COVID case curve, by and large, Indian markets have remained resilient. In May, we saw the Nifty index rise by 5%, while the broader markets continued to outperform. In dollar terms as well, over the last month, India has outperformed other emerging markets. While foreign institutional investors turned net sellers of Indian equities in the months of April and May 2021, the domestic institutional investors have turned net buyers, and hence on an overall basis, institutional flows have been largely balanced. Now, there is no denying that the human pain and tragedy that the second wave of COVID has unleashed is significant. Almost 50% of cases are from 5 large states. However, on the positive side, active cases are declining in regions that saw early waves. States such as Delhi, Maharashtra, and Chhattisgarh are seeing a plateauing out of the case curve and improvement at the margin. Now, while the spread of cases to rural area and the death rates are worrying, regional lockdowns are working. New cases have fallen 23% last week, and in fact, active cases are now 33% of their peak. From here on, the key to watch out for will be the pace of vaccination. Almost 11% of the Indian population has received at least one shot. In the last month, supply-side issues have surfaced, resulting in slowdown in the pace of vaccinations. However, it is expected that the supply trajectory would improve from here on. The government has approved the Sputnik vaccine, and the 2 vaccine manufacturers are expanding their capacity, which should address some of the demand-supply gap. It must be noted that in the large cities, the percentage of the 45 plus population that has received at least one dose is high. As this number scales up, the pressure on the healthcare infrastructure and the death rates should start to come down. Let's look at the impact on growth and earnings. Now, economic activity has slowed significantly in the month of May. Many of the high frequency indicators are slowing down to levels of activities seen in the month of September 2020. Many states have initiated a lockdown in order to control the COVID cases. However, we must note that the contraction in economic activity is lower as compared to the levels seen last year, with services and mobility indicators being impacted much more than manufacturing. With active cases declining in many districts, and even before lockdowns are lifted, Google mobility indicators are showing some signs of improvement. However, the impact of the economy and earnings of the COVID case trajectory will be clearer only over the next 1 or 2 months. A lot depends on the nature and duration of the lockdowns. There is likely to be a drop in GDP in the next 2 months, which means that there could be a 1 to 1.5% cut in GDP estimates for FY22. The actual impact may be lower depending on how economic recovery pans out in the latter part of the year. Now, this is particularly so because this time around, firms are actually prioritizing on continuity and supporting supply chain partners. Now, in terms of corporate earnings, the last 2 quarters, that is Q2 and Q3 of FY21, show sharp earnings upgrades. We are now in the middle of the Q4 earnings season. Now, while the Q4 season has not seen major upgrades, the results declared so far have been in line with expectations. Q1 of FY22 would be the true reflection of the impact of the lockdowns. And in line with the moderation of economic growth, we do expect to see some moderation in earnings expectations for FY22. Despite this, the overall earnings growth trajectory would remain fairly healthy, improving in the second half of 22. Policy, both fiscal and monetary, would likely remain supportive of growth. Now let us turn to valuations. On a headline price to earnings or a price to book value basis, Indian markets are clearly trading at the upper end of their valuation bands. However, on a relative basis, Indian market premium to emerging markets are not significantly above their average levels. Further, on an EV/EBITDA basis, the valuations are at long-term averages, and the yield gap between the earnings yield and bond yields appear to be closing out. There is also a fairly large disparity that we see in terms of valuations across sectors. Now, with this backdrop, we retain our stance of being neutral in terms of equities on overall asset allocation basis, with a slight preference for mid and small caps. In the near term, it is possible that markets may remain range-bound given the stalled economic momentum and lack of clarity on earnings progression. However, news flow on disinvestment of PSUs, bad bank, stimulus or supportive policy can result in overall sentiment improving. The global markets are likely to remain buoyant, and this could also have a rub-off on the Indian markets. So far, over the last year, mid and small caps have outperformed the large caps. We do expect that the broader market would continue to perform better given the linkages to economic recovery. Earnings delivery, however, will be very, very crucial in order for this momentum to sustain. From here on, the things to watch out for will be the progress on the vaccination front, the COVID case trajectory, commodity inflation, and earnings growth. So what are the key themes that we are looking for in our portfolios? We have so far adopted a barbell strategy in terms of our portfolios, with exposure to both domestic cyclicals like industrials, cement, and banks on one side, and defensives like IT and pharma on the other. We believe that the big will continue to get bigger, and the shift in market share from the unorganized to the organized segment is likely to continue. Supply chain shifts away from China are now visible, and this is likely to remain a structural theme. In the near term, while there is uncertainty, we do expect to see revival of manufacturing and the investment cycle in the medium term. Some signs of this are already visible in terms of household and public capex. While the large ticket private capex is still some time away, this is a segment to watch out for. Finally, digital adoption is here to stay. Companies that are the early adopters of digital technology would have the first mover advantage. In conclusion, I would like to remind you that timing the market is extremely difficult, and hence we would urge you to continue with your disciplined approach to systematic investments in equities. Do stay safe, stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.